with this idea of what causes another major rupture. What is the canary in the coal mine? Jamie Dimon has been very vocal for some time that it will be the bond market, that its cracks are coming in the bond market, be it 6 months or 6 years from now. Is that what leads us into the next shaky period for markets? Is it the bond market that we should be concerned about?
Well, generally speaking, it's usually credit that leads you into a problem. Is it going to be government credit? That's the harder question to answer. And I think right now there are a lot of questions about all sorts of credit, but at the same time, there's still a lot of money chasing those dollars and looking for yield. So I don't know that it's as much of an immediate problem as it is a consistent thing that needs to be addressed, and whether or not it can be addressed. Scott Bessent wants to do it over a longer period of time, over a shorter period of time. It's going to need to be addressed at some point, and it's good to be discussing it. But whether or not that is what causes the dislocation, I'm not so sure.
You made a very good point earlier, which is the fact that historically speaking, the dollar's not even that low.
Well, and this is what it goes back to, there's all those horrible cliches like the worst dirty shirt in the laundry and all this sort of the best of the worst, right? So currencies are a relative game against one another. So then you have to find something that you say, okay, the prospects are much better there, therefore, or the rates are much higher there, therefore that currency is something I want to chase. You're back to the dollar and the U.S. economy being so important globally that it's difficult to separate yourself from that. On the margin, you can move money around, and you can certainly, and people have in the last 6 months or so, started shifting to other markets. But at the same time, you still have a bigger growth engine in the U.S. than you have in most of the other parts of the world. And that's difficult to ignore.
Well, even so, Sarah, let's say you're a UK investor in the U.S. You're still looking at losses for the year because of what the dollar has done if you're not hedged. In a totality of a view where the dollar is weakening and that is the trend, does it make investors more likely to sit locally? Does it just impact the flows of where dollars are going, especially in equity markets globally?
I think it definitely impacts your next choices, so the new flows as opposed to the older flows. But generally speaking, holding on to assets for a longer period of time has been what you want to do if you go back and look at even with the dislocations in equity markets. So yes, I think on the margin, again, it changes where people might put that next dollar and might put it for the next 3 to 6 months or 12 months. But from a longer term perspective, it's hard to see diversifying out of the U.S. on a permanent basis as something that's really going to end up being beneficial.
So there's a story on the Bloomberg Terminal this morning. Buyers strike rocks U.S. long bond as double line PIMCO stay away. We were speaking with J.P. Morgan's Bob Michael about how the 30-year bond is a risk asset. We ask every single investor who comes on, are you buying the 30-year yield? Are you buying 30-year bonds right now? Do you think that that is an attractive purchase? And what would it take for you to like that? So I ask you that. What would it take for you to actually want to load up, back up the truck for 30-year treasuries?
I'm going to be just like everybody else, sadly, and say no, not right now on the 30-year.
Why? So why?
So that's a question of timing and yield right now, and I think that's the problem and that's the tension. Because if the expectation is I need a higher yield to feel more comfortable with the 30-year, then that's a problem for the rest of the yield curve, possibly, and it's a problem for yields because they need to go higher. The price movements on the longer-term bonds are much more significant to your portfolio if you're not going to hold it to maturity. If you have something where I can match that duration to the yield on the 30-year, then there's no reason not to buy it as long as you're going to hold that. It's the volatility in between, and I think that's why people look at it as a risk asset, because when the price moves, it moves. I mean, when the yield moves, it moves more price-wise.